Hello! Are you following the gold price and interested in seasonal variation in performance of this precious metal in the financial markets? Well, in this video I share a temporal and seasonal analysis of gold in US dollar per ounce since 2001. I'm Jimmy Lepping, a psychologist and statistician with loads of interest in a variety of research topics, including the financial markets, and since a month and a half ago I also have my own YouTube channel. So here you see a chart of the daily gold price since early 2001 all the way until 2023 year to date, meaning well over 5,500 trading days. And for each day I use 4 price moments, open, high, low and close, meaning that this chart comprises well over 22,000 data points on the gold price in US dollar. You see that although gold has had its relative ups and downs, it is now much higher than it was nearly 23 years ago. And in earlier videos, I also compared the performance of gold versus stock market indices, showing that if you invested in gold 20 years ago instead of in the S&P 500 or one of the European stock market indices, well, with gold you would have seen higher returns today. Here you see the month chart, which is barely different from the day chart, visually speaking, because of the long time period and relative density of data points in the chart. Now, when you look at the quarter chart, well, you get this. By the way, in these charts, the vertical dashed line separates 2023 from all the previous years. And the 3 horizontal dashed lines indicate the lowest high, the median close, and the highest low, respectively. These are 3 reference lines that I tend to include in my charts to make sense of where we are. Now, as you can see, we have been hovering around the upper dashed line, which is the highest low, and is in an area that has repeatedly been an area of resistance. The few times that the gold price has for a moment crossed that line, it has come back. And well, any predictions really in previous years that the gold price would be at 3,000, 5,000 or 10,000 by now, well, they have been wrong so far, clearly, because well, the area just over 2,000 is turning out to be a heavy resistance. It keeps coming back. Here the year chart, where you see this even more clearly with on the one hand higher lows, but well, with the exception of a few incidental dots that are barely visible in this chart, there is no clear evidence of higher highs since 2020. And here, well, the chart with blocks of 3 years, which illustrates the situation quite well too. And in the block on the right, which represents 2022 onward and therefore will still include 2024 as well, the bottom is, at least for now, in the lower 1600s, somewhere 1620s, I think. Yeah. Okay, now next let's have a look at the monthly percentage difference, that is gain or loss, over the 275 months of data we have, because December 2023 is still in progress. And while what this chart shows is not much of a difference in monthly performance across time. Looking from another angle on the horizontal axis, instead of expressing time in months but in years and allowing years to vary freely, we see that while although there is some variation over time, some differences between years, the differences within the years are clearly more impressive. Now, when we look at the monthly performance across years for each calendar month to determine if we have seasonal effects at the level of month, again we see some differences between months, but a much bigger variation within the calendar months. And finally, using official categorizations of recession periods, we see that gold does not appear to meaningfully outperform or underperform in months that are part of a recession period, which is indicated by the chart on the left. And then the chart on the right and also the autocorrelations below help to assess whether gold can be conceived as an important leading or lagging indicator of a recession. For instance, as in clearly better or clearly worse performance in the months prior to the start or after the end of a recession. Well, what these numbers indicate is that gold is that well, there is no evidence in favor of gold as a leading or lagging indicator of a recession. That is pretty much uncorrelated. Finally, you see here the different models that we've seen so far compared in terms of an R-squared statistic, which indicates the percentage of variation in monthly performance we can explain with the model, and a Kaikes and Schwartz Bayesian information criteria, abbreviated AIC and BIC. While higher values are better for R squared, lower values are better for AIC and BIC. These information criteria basically help to assess whether an increase in R squared is sufficient enough to justify a more complex model, or we might as well do with a simpler model because that explains about the same. And well, what we see here is that both information criteria prefer the so-called null model, which is basically a horizontal flatline model that states no time trend, um, no seasonal effects, no recession effect, or any effect whatsoever. Which is interesting because, well, sometimes you hear claims in the media and social media that it is good to buy gold in particular months of the year where it is believed to be cheaper, and better to sell gold in specific other months of the year where it is believed to be more expensive. And well, for instance, some traders also claim that gold performs poorly just prior to or during a recession. Well, when you look at the data over a longer time period, there is no evidence of this. Now, remember that this is an analysis of gold prices and gold performance in US dollar terms. So if you want to know how the picture is in the Japanese yen, the Indian rupee, the Chinese yuan, or any other currency, well, I invite you, of course, to do this analysis for your currency of interest. But since the aforementioned claims about temporal and seasonal effects of gold are widely shared, in the media and social media, as well popular wisdom of the crowd regarding gold in US dollar terms, well, these findings point against these claims. Okay, that's it for this video. I hope you find this useful, and if you have any ideas or suggestions for future videos, you can leave a comment below the video or just drop an email using the email address that I have shared below this video. Thank you for listening, have a good day, and see you soon.